The National Association of Equipment Leasing Brokers is the only leasing trade association developed by brokers for brokers. NAELB is over 10 years old, has more than 500 members from across the United States and Canada, and is growing rapidly every year. The NAELB is underwriting this tape series for our members as part of our ongoing commitment to excellence in leasing education. There are many compelling reasons for brokers in the leasing business to join NAELB. All members of the association subscribe to a code of ethics and agree in writing to be held accountable to that code. Members have free access to the NAELB attorney to assist in resolution of disputes, review contracts, or ask help with any legal question. We provide our members with dispute history information on funders and other brokers to assist in fraud prevention. NAELB has many funding sources that participate in our educational conferences throughout the year. Those sponsors help reduce the costs of these events to our member brokers. However, those funding source members are not voting members of the NAELB. That privilege is exclusive to broker members. It's the broker members who run this organization. The association website at www.naelb.org continues to grow and provide members with funding sources, information on fraud prevention, leasing education, and direct contact with their NAELB Board of Directors. As the leasing industry continues to change, brokers need to continually educate themselves to stay competitive and improve their bottom line. If you or someone you know would benefit from all the services provided by being a member, contact the NAELB at 800-996-2352. Welcome to the NAELB Education Series presented by Bob Baker. Bob is the Director of Education of the NAELB and was the 33rd person to receive the prestigious designation of Certified Lease Professional, CLP, the hallmark of knowledge and excellence in the equipment leasing industry. Bob was the first recipient of the Bill Granieri Top Gun Memorial Award. Bob brings to this educational series over 30 years' experience in finance and leasing, and is founder and president of the Wildwood Financial Group, the premier leasing education company in America today. Thousands of leasing professionals have attended Bob's seminars, workshops, and presentations through the years. We think you'll find that Bob's relaxed approach to the subject of leasing makes it easy to understand the key concepts that underlie success in our industry.
Hi, I'm Bob Baker, and I am very excited, as well as being honored as the Director of Education of the National Association of Equipment Leasing Brokers, the NAELB, to present to you this video training series. This series is designed for the novice as well as it is for the person that's been in the business for quite a while, and it can be a refresher for folks that have been in the business for a long time. I'm going to be talking to you for several hours on these videotapes to give you some very specific knowledge, but I want to do this in a format that is just like I was sitting talking to you, so it is not designed to have everything exactly as it would be in a CPA's mind. It's not to be exactly as it would be in as an attorney's mind. So these are general, overall things that we're going to try to share with you today. So, you know, as with anything else, you should always get the opinion of your attorney or your CPA for specific legal or accounting issues. All right, let's talk about the documentation that's involved in putting these leases together. The documentation, again, is going to vary quite a bit from funding source to funding source, and I'm not going to even attempt to go through every document that's involved in the leasing industry because they are very, very, very large in scope. So what I want to try to do is to go through the primary lease documents and the ones that you won't use all the time, but that are the ones that are the most common that you'll run across, so that when you are getting these signed up, you will at least be able to talk intelligently about them. The first document that we need to deal with in the process of documentation, believe it or not, is not the lease agreement, but it's the credit application itself. One of the things to remember about the credit application, besides all the information that we've obtained on it and filling it out correctly, is that on the bottom of the credit application, we need the lessee to sign this because it says a couple of things. It says that all of the information that's on this credit application is correct. So even though you may have taken this credit application over the fax machine or over the phone and already done your credit investigation and everything else and ready to sign up your lease, it is still important to get the credit application signed, even though you don't have to have it signed, because it says that all this information is correct. I don't want to belabor this point, and I'm overly simplifying it, again, not trying to give you legal advice, but one of the rules, kind of thumb of bankruptcy, is that you cannot file bankruptcy on fraud. So if the information that we received on this application is fraudulent, we might be able to go in and break the bankruptcy for us if we can show substantially different information in reality than what was on the credit application. But if the credit application is not signed, then you're not going to be able to document that discrepancy. Secondarily, in the application itself, it also, excuse me, it also gives us the permission to go out there and check their credit bureaus, their banks, their trade references, and things like that. Now, I've heard mixed things on this as far as these credit bureaus are concerned, and you're going to get mixed signals from different funding sources. From the information I have been able to ascertain myself, and I've heard conflicting information from other folks, you do not need to have a credit application signed in order to check credit because this is for a commercial transaction. Therefore, we fall outside of the normal truth in lending guidelines. But it is always a very, very good idea when you do your documentation, if you don't have the credit application signed, to send the credit application along with the rest of your lease documents and have it signed. One of the things I would suggest that you do is that I would go out and buy some stickers, and you can get these from any office supply house or you know, CompUSA, a lot of places, and they're just stickers that stick out of a form that you can put on there that have arrows. You can get them in red, yellow, green, or whatever that says sign here, date here, that type of thing. If you'll do that, they're very inexpensive. They don't take long to put on, and it makes it much, much harder for somebody to miss a signature or to miss a date. And again, if that happens, you can get yourself into a redocumentation situation or having to send a document back out to have it signed. And again, that slows down your funding to your vendor, and that's not service-oriented, and that can cost you relationships. Now, the next form that we have next to the credit application will be the lease agreement itself. Now, the lease agreement has the terms and conditions of the lease. It has the lessee's name up there. It has who the funding source is up there. It has a place for description of the equipment. Now, some companies will put the description of the leased equipment in that section on the lease agreement, but a lot of them, because they're using word processing and different software programs, the software will automatically type in the equipment description area, see Schedule A attached, which will be a separate schedule, and we'll discuss that in just a moment. What you want to do on your lease agreement, and I know this is a little tedious for those of you that are new, but you should go in and you should read the fine print in this entire lease, front and back. If there's something that you don't understand, you should highlight it. Talk to your manager or your accountant, or one of the advantages that you have of the NAELB is you have free legal, and you could call the NAELB attorney and discuss it with them as well. You're going to find that a very, very large percentage of the lease document itself, and I've never put a percentage to it, but I'll bet it's probably 80% of the lease document, is a couple things. One is all the disclaimers that are made in the lease document saying that The lessee selected the vendor. We're not responsible for the equipment. If the equipment doesn't work, you can't quit making your payments and things like that. And then we're also going to have what are known as defaults. Now keep in mind that in a lease agreement, there are a lot of events of default in a lease, and you need to know what those are. If you take a typical loan agreement, like on a bank loan, you basically have defaults if they don't make their payments on time or they don't keep insurance. You're going to find that in a lease agreement there are many, many, many more events of default. We can have events of default if they're not paying their taxes, if they're not keeping the equipment in good condition unless normal wear and tear, if they file bankruptcy, even if it's a Chapter 11, if there's a material adverse change in their financial condition, if there's a change of ownership, if they allow any liens to be encumbered on the equipment, if they refuse to give us financial statements when we request them during the term of the lease, if they move the equipment without the written permission of the leasing company. There are many, many events of default, and that takes up a lot of room in these documents. And then you will find that there are remedies that say if there is an event of default, all the different remedies that we have to be able to go in and collect that particular lease. So you should take the time to go through the lease agreement and be sure that you understand the various components that are there. Now, one of the things that I want to point out, or a couple things I want to point out in the lease agreement is, one, you will notice that there's a choice of law provision in virtually every lease. Normally, this choice of law provision will be in the home state of the lessor. So if the company is located in Oregon, it will say the choice of law is Oregon, which means that if they sue, the lessee will have to come to that state to defend it. And choice of law provisions are very important, and they will be in every lease agreement. Another one that is very important, and we'll tie this up as we go through some of these other documents, there will be a statement in the lease agreement, usually in one of the very last paragraphs, that says something like, this is the entire agreement. There are no other agreements, oral or otherwise, unless in writing by both parties. So if we're going to do anything that is different than what is in the actual lease agreement itself, then we have to do an addendum to the lease. And since the wording in the lease says there are no agreements, written or oral, unless signed by both parties. So that means if we do any kind of an addendum, it's going to have to be signed by the lessee and by the lessor. Okay? Now, the next agreement that we have, when we put a sample one here in your workbook, is an EFA, Equipment Finance Agreement. Now, the EFA, as we discussed, is really a disguised loan. In the situation of an EFA, the leasing company will have a lien on the equipment. They will not have ownership. And, of course, the provisions and disclaimers will be a little bit different. Some of you will not use EFAs at all. Some of you will use them quite a bit. And in some cases, with some funding sources, for example, on titled vehicles, they will tend to do EFAs. A lot of times, you will find that an EFA is going to be used because the leasing company does not want the liability of ownership that goes along with the lease. The next thing that we want to discuss is the master lease agreement. Master lease agreements, for most of you, will not be a common thing to use, but it does have certain situations where it gives you some very, very strong advantages. The premise behind a master lease is that we have a master lease, in other words, a primary document that will turn around and it will control the rest of the documents that go with it. Let me try to put this in a practical application for you. You have a company that has come to you because they're getting ready to open up a second location, and they have maybe 7 or 8 vendors. Let's say this is a restaurant and they have a walk-in cooler coming in. They have an Ansel fire protection system for their stove. They've got Hobart mixers and things coming in. They've got furniture coming in from another vendor. They have bar equipment coming in from another vendor. They have a security system from another vendor, a phone system from another vendor. You might have 7 or 8 vendors. Since we typically cannot pay the vendor until the equipment has been installed and working properly, if we have multiple vendors on one lease, then if one of the vendors is dragging their feet getting their equipment in and all the other vendors have turned around and fulfilled their part of it, we can't pay them because the lease isn't completed because we're still holding for one vendor. So what we can do is just take a master lease agreement that has basically all the terms and conditions and the remedies and defaults and all those things that we just discussed in a lease agreement, but it doesn't have a place for the amount of payments or the term or things like that, just the guts of the lease agreement itself. And then what we're going to do is we're going to have appropriate schedules that go along. So if, for example, the company that's putting the security system in is done, and that's $10,000, we can turn around, do that lease, that schedule, for say 60 payments at $250 a month. The lessee signs acceptance of that equipment, signs that schedule, and those payments begin immediately. Then a week later or 2 weeks later, something else is done, that schedule is signed, that payment is added to the next payment, and now they will be billed for the total of the two. So you can have multiple vendors on the same lease. The other advantage that a master lease has is that the schedules do not have to be the same. You could have one schedule for 36 months, one schedule for 60 months, one schedule for 48 months. One of the reasons you might want to do that is that if they're getting a bunch of furniture, they may want to do that lease for 5 years, but the computer equipment they know will be obsolete, or it could be their cash registers, and they're going to want to replace those every 3 years. So they can do them on different terms. Another reason that you can use a master lease is that if a company is constantly changing and upgrading equipment, if they're buying a bunch of computers for 3 years and now they buy some printers and they're already 4 months into this lease on the computer systems, we might want to do that schedule instead of doing it for 36 months, do that lease schedule for 32 months. That way the new printers and the computers will be coterminous, which means they'll both pay out at the same time. So there's a lot of advantages to using a master lease agreement for marketing reasons and to make your amount and bulk of documents a little bit less. Now, one of the most important forms in a lease agreement is the delivery and acceptance agreement. It is very, very common in our industry to get a transaction request in, do our credit investigation, get the transaction approved. The vendor then sends us an invoice. We get all of the lease documents signed with the exception of this delivery and acceptance. And then a month later, when everything is completed, then the lessee signs the delivery and acceptance agreement. Now, the delivery and acceptance agreement primarily says 3 things. Number 1, the equipment has been delivered. Number 2, the equipment has been installed. And 3, the equipment is working properly. Typically, in order to pay a vendor, those 3 events need to have taken place. The equipment has to be delivered, it has to be installed, and it has to be working properly. Now, there are exceptions where progress payments can be done, but in a delivery and acceptance agreement, the lessee is signing off saying everything's here, everything's been put in, everything's working fine, please pay the vendor. Now, I don't care what funding source tells you what, I don't care what somebody asks you to do. In my opinion, never, ever, ever have the lessee sign a delivery and acceptance receipt unless you know the equipment's been delivered, it has been installed, and it is working properly. If a funding source requests from you to sign a DNA, a delivery and acceptance, prior to it being installed, let's say the lessee says, yeah, everything's here and they're putting it in, and they say, well, go ahead and get it signed, but don't have them date it. We'll date it when we verify it. My suggestion is to you, do not do it. You are asking the lessee to lie. The statement says it's installed and working properly. It isn't. You know it isn't. And when you ask them to do that, you're asking them to commit fraud. Do not get those signed until the lease is completed. Otherwise, you can create yourself a multitude of problems. So the DNA normally is the final piece of paperwork that's signed, and this is what trips their next scheduled payments. In most cases, the next scheduled payment will start 30 days after they've signed the DNA. Now, in some cases, you're going to have companies doing interim rents and things like that, but this is the thing that trips the lease and actually makes the lease into a lease agreement. Now, let's talk a little bit about the invoice and bill of sales. When you have a transaction approved by your funding source or internally, the next thing you're going to need to do is to get an invoice from the vendor, because this is a document that is going to show transfer of title from the vendor to the leasing company, and there are certain things that must be on this invoice, and you're going to find that your funding sources are going to be very, very inflexible on several of things here. Number one, the invoice must have the word invoice clearly marked on the piece of paper. It cannot say bill of sale, it cannot say pro forma invoice, it cannot say billing statement, it has to say invoice. That's a legal term. You're going to have the words sold to on the invoice. It can't say bill to. It has to say sold to. Sold to will be where the lessor's name goes. So that will be your name if you're going to be the lessor, or if you're brokering this to a funding source, the funding source's name will go in there as sold to. It must say ship to. Again, not bill to, ship to. And it must show the lessee's name, their address, city, and zip code there. The invoice should always have on it whether the equipment is new or used. That is very important to have on the invoice. There should be a description of the equipment, model numbers and things like that. You should have the serial numbers, and then you should also have on there the amount of the equipment and appropriate tax, if any. Some leases are going to be done with use tax. Some leases are going to be done with sales tax. Generally speaking, this can be a very complicated part of doing your documentation and your lease agreements, but it shouldn't be a primary concern, because this will be dictated to you by your funding source whether this particular transaction should be done as a use tax or whether or not it should be done as a sales tax. What's the difference between sales tax and use tax? Sales tax is tax on the equipment. Use tax is a tax on the payment. When we have a situation with sales and use tax, we have to determine, when we charge sales and when we charge use tax. Some states in the United States are sales tax states, some states are use tax states, some states are both, and in the states that are both, normally a funding source will have to make a declaration at the beginning of the year whether or not they want to do their transactions as use tax or sales tax. But there are just scores and scores of exceptions. For example, in Illinois, it's normally a use tax, but if the vendor and the lessee both reside in Illinois, then it's sales tax. So the funding source from your credit application, and again, this is why it's important that you have the proper county and the location of the equipment properly, this will normally be dictated to you by the funding source, whether it's sales tax or use tax. If the funding source gives you an approval that says this is a 6% sales tax, then the vendor should include sales tax on the invoice. So if the equipment cost is $10,000, sales tax is at 5%, then we should have an invoice showing equipment cost $10,000, sales tax $500, amount due $10,500. That is the amount our payment will be calculated on, and then when the transaction is completed, a check will be sent to the vendor for $10,500, and it will be the vendor's responsibility to remit the $500 to the taxing jurisdiction. Now, in the event that this is done as a sales tax, and you sometimes will have vendors go, well, wait a minute, I got to charge sales tax. We'll do it as a use tax. They do not put tax on the invoice, but when the funding source sends out the check for the $10,000, they will also send them a blanket exemption certificate showing that this is a lease and they were not responsible for collecting the sales tax. Now, bill of sales. When are bill of sales used? If we have a company whose normal course of business is selling copiers, they are exempt from what is known as UCC law. In other words, we don't have to worry about whether or not the equipment is encumbered, but because legally, by giving us an invoice, they are giving us free and clear title to the equipment. But you will sometimes run into a situation where a vendor of the equipment, who by definition is the supplier of the equipment, is not in the normal course of business selling that type of equipment. So let's say that we have a company that's in a construction business that is selling a backhoe that they no longer need, and that is being sold to another construction company and you're doing a lease. In that case, we're going to get a bill of sale, and we'll probably have to do a lien search on the equipment, but since they are not in the normal course of business selling that equipment, we'll need a bill of sale there instead of an invoice. Now again, this can vary from funding source to funding source, so you want to keep that in mind as we go forward. Normally also, when we're using an EFA agreement, we will get the equipment finance agreement in lieu of the lease. We will end up being required by the funding source to get a bill of sale instead of getting an invoice. Now, there's three documents that are pretty much the same thing that we're going to talk about now, and that's the corporate resolution, resolution of partnership, and the sole ownership affidavit. A corporate resolution is a piece of paper that is going to be required by some funding sources, and especially on larger transactions, that basically says that the person who is signing the lease is authorized to do so by the corporation. The piece of paper actually says there has been a meeting of the board of directors and blank, whoever that person is, has been authorized to create debt for the corporation. If, for example, and let me explain to you why this resolution can be so important. Let's say the president of the company is out of town and an office manager decides that they have to have a brand new computer that'll do some neat stuff, and they go to get the equipment, and the vendor offers them a leasing program. This office manager gives them all the financial information on the company. They check it out, they approve them, they deliver the computers the next day. The office manager, the vice president of the company, signs off on the lease agreement. And let's say this lease is for $75,000, and it was done as a mini lease. When the president of the company comes back a month later, he sees the receivables come across, the payables come across his desk for approval, and he sees this payment to this leasing company, his computer, and he goes, "What is this?" And the office manager says, "Oh, this is a new computer system that we got last month and you're out of town. We had to get it, but it was a really good deal." And he goes, "It's ridiculous. I don't want that computer system." Well, I'm sorry, Mr. President, but I already signed the lease agreement on it." "Well, I don't care. Give me the name of the leasing company." So the president of this company calls up the leasing company. He says, "Listen, we got a lease here that one of my office managers did for this computer system. I don't want it. Come get it." And the leasing company goes, "Well, sir, I'm sorry, but we've already approved your credit, and they already signed the lease agreement and gave us 2 advance payments." And he goes, "Well, I want the advance payments back, and you can come get your equipment." I go, "Well, I'm sorry, but they've already signed it." And you go, "They are not authorized to create debt for this company. Do you have a corporate resolution authorizing them to sign on this lease?" And they go, "No." "Then come get your equipment and give me my money back." And legally, they're going to have to do that. So the resolution is the piece of paper that says that whoever signed the lease was authorized to do that for the company. Now, typically, the resolution will name the person that's signing, usually the president in our case, and then it is signed by the secretary with the corporate seal on it. Some companies will not require you to get a corporate resolution, especially on smaller transactions, and the reason that they do that is because their logic is that on a transaction for $30,000, $40,000, $50,000, that there is an assumed authority there. that if, for example, as long as the president signs it, they don't require a corporate resolution because there's an assumed authority, since they are the president of the company, that they are authorized to sign it. I would strongly suggest that if you have a funding source that does not require a corporate resolution, but your broker agreement with that funding source says you're responsible for the contract being genuine and enforceable, that you have some kind of addendum to your broker agreement that says that that's fine, but I'm not responsible for a corporate resolution for the contract to be genuine, and that you don't require it. Because remember, your broker agreement always follows the transaction, and if they were to sell that deal off and another leasing company lost in court because you didn't have the resolution, you could have some potential liability there. Now, the next form that we have is a resolution of partnership. This is in essence exactly the same thing as a corporate resolution, but it is for a partnership, saying whoever signed for the partnership was in fact authorized to do so. And then some companies will also have what's known as a sole ownership affidavit that basically says that I am a sole proprietorship, therefore I and the company are one in the same. And so these all three do the same thing. They show that we have the person that has signed the lease is authorized to do so, which makes our contract, when we get into court, genuine and enforceable. All right, let's visit about the personal guarantee. Now, as we have discussed previously, you're going to be required in almost every instance to get, especially in small ticket mini lease transactions, to have the personal guarantee of the principals or principals on the lease agreement. Now, this agreement says that in the event that the company doesn't pay, that we're going to go after the guarantors. And different companies will have different provisions in these personal guarantees, but there's a couple things in most of them that are probably important for you to know. It says in the event of default that the leasing company does not have to go after the company. They can simply just take the easiest target, and they can come directly to the personal guarantor, and if they feel that's where the strength is, they can just sue the guarantor for the payments without having to go through repossession of equipment and things like that. There's a lot of varying legal things on that, and that will vary from company to company, so you need to read that agreement carefully. But the substance behind the personal guarantee is that if the company doesn't pay, this is a document that allows us to go after them as an individual. Let's visit about a cross-corporate guarantee. In some situations, the entity that you're trying to get approved does not have significant financial strength. That doesn't mean that they've had slow credit or things like that. They just may be a little weak for the amount of their request, and that's what happens in a lot of cases. So we need to do some kind of credit enhancement. We might not have CDs or letters of credit or something like that available, but we do have this individual that has this 2-year-old company, let's say, that has another company that they own that's been in business for a substantial period of time and has substantial strength, and so we can use that company to guarantee or co-sign for the weaker company. We do this with a form called a cross-corporate guarantee, which allows one company to guarantee the credit for another one. Now, some companies will do this in the form of a cross guarantee, which says that this company is also responsible, and some will want to do these as co-lessees, jointly and severally responsible. There is sometimes an advantage to doing these as co-lessees in that collection is sometimes easier in some states that way, and it also gives the companies an advantage tax-wise, because they can put the tax advantages of the lease in either company they want. So since the originating company may be weak, may not need the tax advantages, may in fact be operating as a loss, then they can turn around and put the tax advantages of the lease in the existing company, the stronger company that does have profits and does need a tax write-off. So we use a cross-corporate guarantee as basically an instrument to have an assignment or a guarantee from another company to make the payments in a default situation. Let's talk about purchase option addendums. The typical lease agreement will say at the end of the lease, and it's usually in a paragraph called termination, it will say that the lessee has three options. It will say, one, the lessee may purchase the equipment for its then fair market value. They may return the equipment in good condition, less normal wear and tear, and we talked about the rest of those provisions of return earlier, or they may release the equipment for its then fair market value. So most leases, the lease agreement itself is set up as a true lease and will qualify under 55-540. But in some cases, we may have agreed in front when we did the lease at its inception on what the purchase option will be in a stated amount. For example, we may have done a lease for $20,000 and we said to the lessee, you have the option to buy the equipment at the end of the lease for 10% of the lessor's acquisition cost, which means they can buy the equipment at their option for $2,000. Now, since $2,000 is in conflict with buying the equipment for its then fair market value, and since we know that the lease agreement has a provision in it that says this is the entire agreement, there are no other agreements, oral or otherwise, unless in writing by both parties, then in order to do a 10% purchase option, we're going to have to do an addendum. Now, this addendum will say that the lessee, assuming that they have not been in default and a few other things, has the option to buy the equipment for 10%. So it's a separate piece of paper. We would have the same situation if we were letting them buy it for $1 and they didn't want the tax advantages of the lease. If we were going to require a put, a payment upon termination, where they had to buy the equipment, we obviously have a conflict there because we're saying they have an option to return the equipment or they have an option to buy it and they have an option to release it. There are no options in the case of a put. A put is not an option. A put is, in essence, a balloon payment. It is a payment of the lease. It's a standalone, and therefore, since we are in conflict with the lease agreement, we would need a put agreement addendum that says at the end of the lease they have to buy the equipment. Now, one of the things that you want to be careful of is you want to read these addendums very carefully. We have had pieces of litigation out there and brokers being put in harm's way because they did not read these addendums that their funding sources are requiring. There have been funding sources that have put in the addendum that they have the option to buy the equipment for 10% at the end of the lease. However, they must notify the lessor within 90 days of their intent. If they don't notify the lessor within 90 days of their intent, they automatically renew the lease for 12 more months. So if they have that kind of wording in there, you want to be sure that you understand that, and that if you're signing this or selling it to a funding source, you may very well want to flag this in your computer so that you can call this lessee up and say, listen, your lease is coming up for expiration. You need to be letting the funding source know what's going on here, that you want to buy that equipment, because if you don't notify them with 90 days, your lease will automatically renew. If you just ignore this issue, and this is where problems have been created, you've sold that lease to somebody else. You have no control. But if that lessee waits to the last month and then says, I want to buy it, and you have a funding source that says, sorry, we got you, it's too late, your lease is already renewed for another year, you can rest assured that you're going to get the brunt of that. Your lessee is going to go absolutely bananas and think that you did something to him that you didn't tell him about, which in fact you kind of did, and at the same time you get vendors upset because the lessee's calling. So be very careful if you even want to enter into that kind of, or let your lessee enter into that kind of agreement in the first place. But additionally, that you want to be sure that that liability exists for you. I personally have a little bit of problem with that. I think it's fine if a leasing company wants to write a letter to the lessee and say, you know, you need to let us know what you're going to do in the next 30 days. Your lease is automatically going to renew. But to wait to the 11th hour, 59th minute, and then automatically throw them into a renewal situation, that's where we create problems, and we've already had some litigation on it. So turn around and very carefully look at these purchase option agreements. And again, I've mentioned this before, but one of the advantages that you have with the NAELB is that you have this legal corporate attorney with the NAELB available to you to answer questions on these type of agreements if you're not sure what you're talking about. And then, of course, we just talked about the put agreement, which is your payment upon termination. We also have to do an addendum on that if we're going to have the lessee buy the equipment at the end of the lease. Now, another issue that we need to deal with is a thing called a real property waiver. If you remember, when we went back in terminology, and we also talked about this in the sales and marketing section, in order for us to lease equipment, it must be Section 38 depreciable personal property. If we are going to lease a piece of equipment that is in any way, shape, or form attached to real estate, we could have a very potential problem here, because once it is attached to the real estate, it becomes part of the real estate. Let me give you a real good example of that. What if you were to do a rooftop air conditioner system for a 3-story building? That air conditioner will become part of the building. It is bolted to the ceiling, it's hooked up to the internal wiring and everything of the building itself, and it becomes real estate. If it becomes real estate, we can't lease it. So what we can do is use a form called a real property waiver. What this does is this is signed by the owner of the building and says, I understand that this equipment is attached to my building, but I do agree that it will remain personal property. So it is very important that we do this. Now, we get into some legal issues here, but we're going to do, whenever we get a real property waiver, normally we're also going to file what's called a fixture filing. Now, the fixture filing is filed in the county where the building is located, and it basically, and again, I'm not trying to give you specific legal advice here, but it clouds the title on the real estate. When somebody goes to sell that real estate, that real property waiver has been filed as a fixture filing and shows that it's not part of the real estate. That way, anybody that would buy that building has to also agree that that air conditioner, in this case, will remain personal property and not be part of the real estate. Now, some funding sources will take this pretty much to the extreme. If there's any question that the equipment could be real property, they may require a real property waiver. I've seen this in situations where you may have a machine tool that's just simply bolted to the floor. Since it's bolted to the floor, it could technically become part of the real estate. So if there's even a question, sometimes they're going to require that. If you have a paint spray booth, for example, they've got to cut a hole in the wall and they have to ventilate it, that type of thing. In some cases, they have to run plumbing to them. In some cases, they're very obvious that they are part of the real estate without it, if you were to do lighting fixtures or something like that. So anytime that you have equipment that is attached to real estate, you're going to need a real property waiver. One thing to remember here is that you also want to look at this, because even though the funding source does not require a real property waiver, in some cases you may want to go ahead and get it anyway. They may have missed it, or it could be that down the road it's construed as real estate, and you have to remember that your broker agreements always say that the contract is genuine and enforceable. If it turned out that that equipment was real estate, you could have a problem there. So, you know, you want to be sure you get legal opinions on things like that. But anytime we have equipment that is attached to real estate, then we're turning around and we need a real property waiver. Now, the next form that we have here goes hand in hand with the real property waiver, and this is a consent waiver, and this is the same thing that we have with the property waiver, that we need to get this signed. The consent agreement, in essence, is signed by the owner of the building, And this allows us to go in and take equipment out if we need to repossess it. So the consent is they're agreeing that in the event of a default, we can go in there and get the equipment out. Most of the real property waivers are a combination real property waiver and consent form. So most of the ones that I've seen, these have been put into one form, but not always. It's very important that you have this consent writing in there, because if in the event you had a lessee that moved out in the middle of the night or something like that, and you're trying to collect it, and 2 months later you're going out to repossess your equipment, without the consent waiver, sometimes you can have a landlord holding you hostage, saying that in order to come in there and get your equipment out, you got to pay the 2 months rent that are past due. So it's very important to remember that anytime we have real estate, that we need both the real property waiver so that the property remains personal property, not real property, and the consent agreement that allows us to go on premise to take the equipment out. Now, another form that we're going to run into occasionally, it's on a smaller percentage of leases, but you will run into it, is a location addendum. The lease specifically says, and in fact, an event of default of a lease is to move the equipment without the written permission of the lessor, which totally makes sense. But what if we lease to them a backhoe? What if we leased 10 laptop computers to a sales force that's out on the road? This equipment is on the move all the time, so technically they would be in default by moving this backhoe from job to job. So again, we are in conflict with the lease agreement if we say it's okay for you to be moving it around. So we need a location addendum. This is an addendum allowing them to move the equipment around at will. So we're saying that the lease agreement says you can't move it. We're saying it's okay to move it by addendum, but you must keep, and most of these location addendums will say that there must be a written record of where the equipment is located. So if we wanted to inspect it or we needed to go out and get it, we would know where it is. Now, some leasing companies, and this is not a real common form, but some leasing companies will also have a form that they turn around and they call a disclaimer of ownership. What the disclaimer of ownership does is this tends to be used more in a situation where we have a trade-in on a piece of equipment. And if the equipment has been traded in, then there can be an issue of whether or not the company or the customer has a equity position in it. So if we had, for example, a company that was buying a $30,000 vehicle and they were trading in another vehicle and getting a $10,000 allowance, we're only doing $20,000. There could tend to be an equity position there, and what we do is we get this disclaimer of ownership signed so that there's no question about title of the equipment. This form is not real common, but where it tends to be used is when there is a trade-in involved. The next form that we need to talk about is the assignment agreement. Now, in a situation where a transaction is brokered from a broker to a leasing company, you're strictly sending them in a bill, if you will, or an invoice for the difference between what the cost of funds you were charged by that funding source and what you charged the customer. The difference would be your fee income, and you would turn around and just send them an invoice in with your documentation. But in the case of a discounted transaction where you're the lessor and you're using a funding source, you're not selling the lease, you're assigning a stream of payments to the lessor at a particular yield, and you're still getting the spread between the two, but that's called discounting income instead of fee income. So the assignment agreement specifically states the terms of the assignment, and those are going to vary quite a bit from funding source to funding source, but what is normally in there is that you're assigning X number of payments at a particular yield to a funding source with a net present value of X. The difference is yours, and it also says that you're assigning first right title and to the equipment itself. Now what that means is, in the event of the default, the leasing company that this assignment of payments has been given to can go out and repossess the equipment as if it was theirs. But for tax purposes, the title of the equipment will remain with the lessor, and just first right title and interest to the equipment will go to the lessor's assignee or the funding source in the transaction. Now, a very important form that needs to be completed in many transactions is what is called the Regulation B form. Now, I want you to please make special note of this, because I have seen several occasions where leasing companies have been remiss in this form. This is required by federal law, and you can create yourself some real problems if you forget to get these. Under the law, a person has a right to know, a company has a right to know why you've turned them down if you run credit bureaus. I would strongly suggest that you use a Regulation B letter on every single transaction that you reject. That's the only place these come in play, is when you turn somebody down. Now, the form says why you turned them down. You do not have to get specific. You can stay pretty general. If, for example, you turn them down from information that you received from a credit bureau, all you do is that every credit bureau, if you look on the bottom, it will give you the address of that particular credit bureau. And it may say P.O. Box 390, Springfield, Massachusetts, or something. It might say TransUnion Credit. So on your form, you just put, you turn them down. It's basically a letter that says, thank you very much for applying for credit, but we regretfully are not able to approve you because. And then you turn around and just check the appropriate area or type it in. And if it's a credit bureau, you check information obtained from, and then you just put TransUnion Credit, P.O. Box 390, Springfield, Massachusetts. You do not need to tell them what was in the credit bureau itself. And one of the things that you want to be careful of here, when you do turn somebody down, be careful you do not put yourself in the position of being a credit reporting agency. Unless you know it for fact, don't disclose it. If there's a repossession in a bankruptcy on a credit bureau, you do not know that for a fact. You're assuming that the credit bureau report's correct. The credit bureau report can be wrong. So you just say it's from information on the credit bureau. And that's even more important if you're talking to another leasing company or bank. You start saying, we turned him down because he was bankrupt. If that lessee wasn't bankrupt, you could create yourself some serious legal liabilities there, assuming that the credit bureau was wrong. Now, if you had called a bank and the bank officer had told you or faxed over to you that they had 35 bounced checks, then you could say, I turned him down because he had 35 bounced checks, because you know that for a fact. And again, I'm not trying to give you specific legal advice, and you can check this with the attorneys, but the bottom line is, when you turn somebody down, you send this form out that says, we turned you down because lack of time in business, lack of comparable trades, inadequate financial strength, information that you obtained from credit bureaus, no personal guarantee available, information requested was not supplied, multitude of reasons, and then you sign it out and put it in your file, and you need to retain those for 2 years. Now, next form is the condition report. We talked about this a little bit earlier, but remember, a condition report is what you need any time that you are going to try to lease used equipment. The credit department and the credit manager that's approving this transaction wants to know what they're dealing with here. They want to know what kind of shape this equipment is. They want to know what the model year is. They want to know the accessories on it. They want to know what kind of condition it's in and that type of thing. Again, this is not to be confused with an appraisal. If, for example, you saw a car on a used car lot on a Sunday, and Monday morning you called up the used car department, got a salesman on the phone and say, I saw this blue Cutlass on your lot, stock number so-and-so, can you tell me about it? And he says, sure. It's a 1997 Cutlass Supreme. It's got 33,000 miles on it. It has air conditioning, power windows, power seats, sunroof. The tires have 75% life still left on it. It's got a new muffler. We just stayed inspected it. We gave it a tune-up. It was owned by a little old lady, and it was kept in a garage, and on and on and on. That's not an appraisal. They're just reading that probably off a card, except part about the little old lady keeping it in the garage. So they're reading it off the card, and that would become your condition report. Now, everybody understands that this can be tainted because it's coming directly from the vendor, but we're requesting this condition report from them in writing. And we can also remember when we do these leases and we get done, and we'll talk about this in our fraud section, we can still do physical inspections and verify that in fact the information on the condition report is correct. But remember that we need to get a condition report anytime you get used equipment, and the time to get the condition report's not after you submit it. That should be part of your submission to your funding source. Now, the next item that we need to visit on is a purchase order. Generally speaking, the transaction of a lease will go something like this. We get a request for a lease, we get the credit application and the appropriate financial information, we do our credit investigation, and we get the transaction approved. Upon approval, we will request an invoice from the vendor, and from that we will prepare documents. The documents are sent out, all of the appropriate documents are signed, any checks like advance payments and documentation fees, etc., will be requested at this time, and everything will be returned. The only form that we will not have at this point will be the delivery and acceptance agreement that we signed earlier, because the equipment hasn't been delivered, installed, and working properly yet. Upon receipt of all these documents, typically the funding source or lessor at this point will issue a purchase order to the vendor. The purchase order lays out the terms and conditions upon which we will pay them. Our purchase order in this industry is considerably different than in most, because our purchase order is basically a contingent purchase order, and we do have some outs in case certain performances aren't made. All purchase orders that I've ever seen are going to have the provision in there that the purchase order is based upon unconditional acceptance by the lessee of the equipment. If for any reason the lessee does not accept the equipment, then the purchase order will be null and void. In most cases, a purchase order will have on it, you know, how long that purchase order is for, because we know that typically your approvals are only good for 90 days, so the purchase order may only be approved for 60. If there is anything missing that would be required before the funding source would fund that transaction, that will also be on the purchase order. For example, they may have required an insurance binder, and we talked about that in our liability section with insurance. They may say we won't fund the deal till we get our liability binder in. It may say that we're still waiting for the invoice from the vendor, whatever it is. Any contingencies that are still left out there will be listed on the purchase order. Now, this brings up an issue that we didn't cover anywhere else, and this is one of the things that is very important. You should not be letting your vendors deliver equipment until the documentation is signed. You have a problem, and that is this, and I'll try to make this as simple and as succinct as I can, and then you can get some legal opinions with your attorneys on it. If the equipment has been delivered to the lessee and is on lessee's premises 10 days or longer, title has already passed to the equipment. It has now become a receivable to the vendor. If title is passed, then we have a problem, because title needs to pass directly from the vendor to the lessor, to the funding source. If we have a vendor that has delivered equipment and then now decides that the lessee wants to do financing, and we don't get that accomplished and get our UCC filings, our Uniform Commercial Code filings, done within a reasonable period of time, which has been construed by almost all states to be 10 days, then technically we're dealing with used equipment, and since title is passed, we need to go in and do UCC searches and things like that to be sure that the equipment is free and clear. If you ignore this and you don't pay attention to it, and you assign or sell this to a funding source, It may turn out in the event of default when they go to repossess it, there may be a prior lien on the equipment, and this can put you in a situation where the contract is not genuine and enforceable, and you could have to buy the contract back. So always remember, we don't want the vendor to deliver that equipment until we issue the purchase order, because we're not going to issue the purchase order until we know the equipment has already been delivered and installed out there. Or I'm sorry, not delivered and installed, but we're not going to issue the purchase order until we have all the signed documents back, at which time we can do the UCC filing. Now, we've tried to cover as many forms here as we could as far as the ones that you're going to see on a regular basis. When we get into vehicles, for example, we can get into highway addendums and vehicle addendums and things like that, but they're very specific and they're pretty wide range from state to state depending on where you're doing business. So a lot of the other forms we didn't get involved with in this video series because I don't think they'll be applicable most of the time. There's a lot of legal ramifications and you can't talk about a lot of these other forms in generalities. So hopefully with the sample of each of these forms that you have in your workbook and that you're probably looking at as you're watching this video series, you'll have a good overall understanding of what your documents that are involved in a lease agreement are. One of the difference between a professional in this business is understanding these documents, taking time to read them, so if you do have a lessee or a vendor question one of the provisions or something like that in the document itself, you can give them an intelligent answer. And of course, this is another thing that just makes you look a little bit more professional than your competition.